Ye Dato Muhammad Azmi Mahmud, Deputy Group Managing Director, AmBank Group. To Mr. Ashu's right, we have Ms. Mandy Simpson, Chief Financial Officer, AmBank Group. And to Dato Azmi's left, we have Mr. Ganesh Kumar Nadaraja, Executive Vice President, Strategic Planning and Investor Relations, AmBank Group. Now we'd like to invite Mr. Ashu Ramamurthy to start today's session with a brief presentation. Mr. Ashu. Sorry, Mr. Ganesh to the presentation.
That's Ashu. Good morning, members of the media. I'm Ganesh, Executive Vice President for Strategic Planning and Investor Relations, and today I'm pleased to present to you the key financial performance and highlights of AmBank Group for financial year ended 31st March 2014. Now, for financial year 2014, we met all our key financial targets and recorded a positive upward growth per annum in terms of profitability. PATMI, or profit after tax and non-controlling interest, return on equity, ROE, or earnings per share, EPS, and return on assets continued to show healthy growth. PATMI grew by 10% to 1.7 billion ringgits, which translates into 14.1% ROE, or 59 cents earnings per share, and 1.45% return on assets. Liquidity remained healthy as the group built up of funding, particularly from low-cost deposits. Low-cost deposits registered a healthy annual growth of 11.2%, which is higher than peer average growth of 9.9%. As low-cost deposits compose more than 20% of our total customer deposits, this has contributed to an annual growth of 5.6% in customer deposits to 98 billion ringgit. Deposits growth came from leveraging channels, alliances, and successful penetration of our cash management solutions. Loan-to-deposit ratio of 88.7% remains within the group's optimum level for liquidity management. Now, loans growth remains as one of the group's key focus, and we have been selective in lending it by targeting profitable segments. The group focuses on risk-adjusted returns and is diligent in ensuring that our asset quality is not compromised. The group's gross loans grew by 5.3% to 89 billion ringgit. The increase was supported by faster than industry growth in our non-retail loans, which is at 11.2% growth. Meanwhile, retail loans grew 1.1% as the group continued to be selective in our extending new loans in that space. We have adopted Basel III requirements for capital computation at the banking entity levels. Capital adequacy levels at AmBank, AM Islamic Bank, and AM Investment Bank have exceeded internal targets as well as the minimum regulatory requirements. At an aggregated level, the group has continued to build capital reserves with CET1 or Common Equity Tier 1 progressively growing to 9.7%, which was higher than the group's internal target. Meanwhile, Tier 1 capital level is healthy at 11.2%. Now let's look ahead. Malaysia's gross domestic product is expected to grow by 5.9%. Growth will continue to be supported by trade and investment, prudent monetary and fiscal policy, as well as stable employment conditions domestically. For the financial services sector, the rising young demographic population, rollout of projects under ETP, and under-penetrated insurance industry present opportunities for us for lending, investments, and various other financial activities in both conventional and Islamic space. Meanwhile, industrial challenges remain as regulators continue to adopt prudent macroeconomic policies to contain rising household indebtedness and increase compliance requirements. Asset quality is anticipated to come under pressure from rising inflation and borrowing costs, while price-based competition for loans and deposits is anticipated to compress margins further. Moving ahead, the group, in response to changing business and operating environment, the group's strategic priorities for FY 2015 and 17 will be to 1. Deliver on focused organic growth. The second one is leverage strategic partnerships and deliver on acquisitions. The third is to continue optimize efficiency, and the fourth one is to build sustainability. In summary, we have delivered consistent performance and will remain focused on executing to our clear priorities in the forthcoming financial year ending 2015 to 2017. As the group transform and embark onto a new journey, we are committed to continue being your bank, Malaysia's bank, AmBank. With this, I conclude my presentation. Thank you.
Thank you, Mr. Ganesh. And now the floor is open to questions. The floor is open for questions. Thank you.
Hi, I'm Karina from the staff. Other than organic improvement, what other growth are you looking from with the policy of bank parent to consolidate more the banking sector? You have signed for partnership with one PS. Now, what's your strategy on that platform?
Yeah, look, first of all, I haven't heard that it's official Bank Negara policy for consolidation. I think what I've heard Bank Negara say is that as banks in Malaysia believe it's commercially appropriate for them to participate in consolidations, Bank Negara will be either supportive of it or will not benefit from that. So that's as far as I know anyway. We have our hands full with the 4 key strategic priorities that we just talked about. We know there is a large consolidation play happening with 3 potential parties coming together. We'll see where that goes. We know clearly that we now need to get MetLife and MetLife partnership working for the next 18 months. We need to complete the integrations of the 2 acquisitions we've done some 18 months ago, which will take us the rest of this year, and then build the foundations for future growth of the life insurance and banking business. From an inorganic sense, that by itself is quite a reasonable challenge for us to manage in the context of when we talk about a more challenging business environment. What we've also historically said is, should there be opportunities for us to play a role and add value to shareholders in consolidating the banking sector, we will always be open to it. But we haven't specifically looked at anything today to address it.
Is there any more opportunities?
Look, it's a decreasing pool of opportunities, let's put it that way.
So the key thrust of the group next year would be is summing up the insurance sector, the retail sector, or the insurance sector, or if that's the thing.
So, and if you talk about focused organic growth, which was the first of the 4 strategic priorities, in the retail space, it's about ensuring that we have the right segment. So we talked about focusing on small business banking, which traditionally has been one area where we haven't done much. So maybe that's a big area. I would say S part of the end. Leave out the E, it's just the S part, small business. So clearly that's one segment that we would like to do more in. And we've got some pilots prototypes that we're working on, which we hope to launch nationwide later this year. We've got the emerging affluent segment, and within that some micro segmentation within emerging affluent. Emerging affluent is less about wealth management. Affluent is naturally the place you think about for wealth management. Emerging affluent customers typically much younger demographics. You talk about people who are just got. It'll start with a transaction account, a banking account, an entry-level account for them, which will progressively then grow into a need for financing, maybe for a car, and then other propositions behind it. And then we are a good mass market bank, so we maintain our focus on growing that sector, which is again the largest segment in Malaysia. That's our retail play. So it's not a broad-based play; it's much more a segment-focused activity. In wholesale, we've just bedded down our consolidation from 5 divisions to 2. One built around the customer, the other built around the products and services. Went live 1 April this year. We're in the transition mode. We've pretty much completed most of it. Then it'll be about leveraging our relationships to ensure that more of our products and services are bought by our customers. So that's clearly, and it's broad-based. It's built more around flow business. By that I mean transaction banking, cash management, trade activities, FX rates, and so on and so forth. General insurance, we've talked about. We are the #1 motor insurance player in Malaysia. Just hold on to that position to grow our commercial business over time. And life insurance, we just talked about, it's just building. about just consolidating, ensuring that we integrate MetLife and AmBank together and then taking forward to sustainable growth. That's pretty much our organic growth strategy. And the inorganic stuff, we'll talk about the 2 acquisitions, completing the integration story this year, which is the last bit of it that needs to go in the technology drops, which is happening as we speak. After that, can't hear me obviously. Yeah. And after that, it's about building momentum for headline growth for General Insurance, for example, for us, as well as with the MetLife partnership. Third one is around optimizing efficiency and capital usage, which is around doing what we do more efficiently, in a more customer-centric way, but using what we save to reinvest back for growth. As well as we are readying ourselves with the models required for us to go advanced internal ratings-based model approaches to pricing, as well as managing our capital. It will take us a few years to get there, but that's clearly one that we're working on that will enable us to price for risk better and get some capital benefits at the end of it. And lastly, it's about sustainability. So that's our strategic plan. It's around talent management, technology, branding. So in a consolidating market, in a market where you've got margin pressures, we need to be very, very focused and disciplined on delivering to those 4 strategic agenda items I've just mentioned.
Any specific, like, are you looking at investment banks, are you insurance companies, or are you looking at?
In terms of M&A, there's nothing specific that we're looking at. But that doesn't mean that we will not take a look at it in the future. Should there be opportunities for us to add value to our shareholders, we will take a look at it. It's just at the moment, we've got our hands full.
So have you been approached by any lenders or to pursue an M&A talk so far?
Yeah, look, typically I don't think they'll approach me, they'll approach my channel. So
No one has approached me.
You said there could be some pressure on asset quality. Could you elaborate more on that, and what kind of pressure are you looking at?
Yeah, look, what we've seen in the last 6 months, and we did talk about it at the end of the financial year, is rising asset quality issues, particularly in auto financing, high purchase for us. It's one where we've seen delinquencies come off because we've managed it better, but impairments moving up. And that's a trend that we see is not because of operational issues that we had post cutover for the core banking platform that we put in December. We initially thought that was the case. It appears to be a system-wide issue, and we are a large player in auto financing. And clearly that's a space where we've seen some increase in impairments. The other space we've seen some early signs of is credit cards. They are the 2 big portfolios. The property segment is one that we have said we will continue to carefully manage in terms of our overall portfolio exposure to that segment, but that's one that we'll continue to manage.
So actually, you talked about small businesses, the new opportunities for you that you want to tap on, right? So can you share with me the figures, some of the figures?
In terms of what we get to see in terms of growth. As we said, we are refining our models as we speak. So we did a prototype, we've done pilots with 17 branches. We're finalizing our business model. It will be a liability-led strategy for us in small business. When we talk about that's an entry-level account for people coming into the, wanting to set up a business with limited amounts of financing support early, but growing support over time. We believe it's a big opportunity for us. We have in our own portfolio well in excess of 100,000 customers that we can bank more profitably than what we've done in the past with the right proposition. I need to come back to you with some more details. Wait for the launch, and you'll see us come out with more details. We will be doing a launch once we roll it out nationwide.
Are you looking at a reduced lending growth this year, and in which segments?
Look, I mean, generally speaking, as a bank, we've said market share is not as important for us as risk-adjusted returns for our shareholders and doing business in a compliant way. We've historically said roughly 2 times GDP is what lending growth should be over a medium term. By the way, GDP growth is coming surprisingly strong. We haven't seen that translate into loans growth for us. Our focus on growing wholesale lending will remain intact. That's unlikely to change. We will continue to be more selective in retail.
Any range that you could?
We think the sector is likely to grow at 9 to 10%, perhaps at the lower end of that. We've traditionally said if we grow at 1 to 2% below that, we're not fussed about it.
But analysts is quite concerned. They say we are too optimistic on the loan growth. Yeah. So do you think 9% loan growth is achievable?
Well, if somebody said, would you expect the GDP growth to come out as strongly as it has in the second quarter, the answer would have been no as well. So we need to go back to the drawing board to do more work, to go away and understand how the GDP growth of over 6% has been achieved for 2 consecutive quarters. It looks like it's export-driven, but we'd like to understand the sectors below that a bit better. Look, we're going to be in a slower growth environment with technology. No questions about it. The question is, what is it? We're not sure about it yet.
Do you expect net interest margin to continue to go down?
Clearly, that's under pressure. Yeah. Not just for us, but for the industry as well. And we don't expect that to go away anytime soon. We have in our guidance said we expect a contraction of up to 15 basis points, and we're battling to keep it at that level.
What's your forecast for interest rates? I mean, it's a factor that I want to say, but still, is it going to impact you? What do you expect this year? Has it really impacted your business?
Look, generally speaking, we had positioned our balance sheet for rising interest rates. So we said an increase in OPR should benefit us in the short run. And that's because our variable rate loans will price faster than our term deposits. That's generally how we positioned ourselves. The rate increase, our house view's rate increase was less likely before when it happened. Now, with the recent changes to the GDP growth rates, our view is there's more likely to be a second rate increase this year, perhaps sooner than later, given the growth momentum that we see in the economy. And again, that will benefit us in terms of net interest incomes over the foreseeable future.
Would it be okay to say that you already factored in that 3 basis point hike?
In terms of balance sheet positioning, we did expect rising interest rates. So we had, even before the rate increase, positioned us for rising interest rates. The jury was out between our trading arm and our let me call it strategic economic arm as to whether the rate increase was going to happen or not. But the first rate increase has clearly happened, and there's an expectation now there's going to be one more.
We have one last question. With that final answer, we have come to the end of today's press conference. We'd like to thank the senior management of the AmBank Group as well as members of the media for attending today's press conference. We'd like to invite all of you again for lunch. Thank you.